Over $7 trillion. That's the staggering amount that's been poured into artificial intelligence development and infrastructure over the past 5 years. It's a number so large it's hard to even comprehend. But here's the brutal reality that nobody wants to talk about. Most of that money is gone. It vanished. And the shockwaves are just beginning to ripple through the global financial system. If you're watching this, you need to understand what's happening, because it's going to affect your money, your career, and your future. So if you haven't subscribed yet, make sure you do, because we're covering stories the mainstream media won't touch. The artificial intelligence bubble has officially burst, and we're watching in real time as trillions of dollars in supposed value evaporate like morning mist. Investment firms, tech giants, and venture capitalists all believed the hype. They threw unprecedented amounts of money at AI startups, data centers, and computing infrastructure with almost religious fervor. Every CEO wanted to announce their artificial intelligence strategy. Every investor wanted exposure to the next big thing. But they were all chasing a phantom. The infrastructure investments alone were astronomical. Data centers require enormous amounts of electricity, physical space, and specialized equipment. Companies were building massive server farms at unprecedented scales, assuming the demand would match the supply. But the reality is far different. Many of these facilities are operating at fraction of capacity. The electricity bills alone are crushing profitability. Some companies are spending millions every month just to keep the lights on. Then there's the talent problem. To develop cutting-edge AI, you need world-class researchers and engineers. These people command salaries in the hundreds of thousands of dollars annually, sometimes reaching millions. Companies hired aggressively, building massive teams, paying signing bonuses, offering stock options. But once the initial gold rush ended, many of these roles became redundant. You can't suddenly lay off thousands of highly compensated employees without serious financial and reputational damage. The venture capital sector was especially reckless. Fund managers were competing with each other to invest in the hottest AI startups. They threw money at companies with barely any revenue, no clear path to profitability, and business models that didn't make sense. Some startups were burning through $100 million annually just to exist. The burn rate was insane. When the music stopped, reality set in hard. Large corporations also made catastrophic bets. Tech companies spent billions acquiring AI startups, many of which turned out to be worth a fraction of the purchase price. They invested in proprietary AI research that never produced commercially viable products. They built internal AI teams that couldn't deliver results fast enough to justify their massive budgets. The opportunity costs are staggering. Banks took a particularly brutal hit because they did something incredibly foolish. They invested heavily in AI while simultaneously using those same AI systems to surveil their own customers. They spent billions developing machine learning models to analyze customer behavior, predict financial patterns, and identify anomalies. But here's where it gets dark. Many banks were using these systems not just for security, but to monitor customers in ways that bordered on invasive and arguably crossed legal lines. Customer privacy took a backseat to profit potential. Banks deployed AI systems that tracked spending patterns, monitored phone locations, analyzed social media activity, and even predicted likelihood of default based on personal characteristics. These characteristics had nothing to do with actual creditworthiness. They were profiling customers in ways that would have been impossible just years ago. And they were doing it with AI systems developed using millions of dollars that could have gone toward actual customer service improvements. The surveillance infrastructure became sophisticated enough that it raised serious regulatory concerns. Governments started asking uncomfortable questions. How much data are banks collecting? What are they doing with it? Is this legal? Are customers even aware? The regulatory backlash came swiftly. Fines started piling up. Lawsuits were filed. The PR damage was enormous. And suddenly all those billions invested in surveillance AI systems became massive liabilities. Meanwhile, in the education sector, a different catastrophe was unfolding. Students discovered that they could use AI to cheat on exams at scale. And I mean at scale. We're talking about thousands of students using sophisticated AI tools to generate answers, write essays, solve complex problems, and submit work that wasn't actually their own. The problem became so widespread that universities struggled to even detect it. Large language models like ChatGPT and others became homework completion machines. Students could input a prompt, get a complete essay in seconds, and submit it as their own work. Teachers didn't know how to catch it. Traditional plagiarism detection software was useless because the AI was generating original text, just not original thinking. The academic integrity system started crumbling. Entire institutions questioned whether their degrees still meant anything. Universities panicked. Some tried to ban AI tools entirely, which proved impossible. Others invested in expensive detection software that didn't really work. Some changed their entire educational model, moving away from written exams toward oral presentations and project-based assessments. But the damage was done. The value of a college degree started to diminish in real time. Employers questioned whether graduates actually knew anything, or if they just learned to prompt AI effectively. The ripple effects extended into the job market. If degrees weren't proving actual competency, why hire based on credentials? Companies started requiring different kinds of assessments. They wanted to see real projects, real work samples, real problem-solving ability. This created chaos in hiring and disrupted career paths that had worked for decades. Young people who'd played by the rules, gone to school, earned their degrees, suddenly found those credentials worth less than they'd expected. Meanwhile, the same AI systems that were destroying academic integrity were also flooding the job market. Companies were automating roles that previously required human workers. Content creators found their work being scraped and used to train models without compensation. Customer service jobs evaporated. Data entry positions disappeared. The job displacement happened faster than anyone anticipated because companies realized they'd already paid for the infrastructure to do these things. The financial markets were particularly sensitive to all this. Stock prices for AI companies had been inflated by pure hype and speculation. Once reality started setting in, valuations adjusted downward. Some companies that were worth billions on paper suddenly faced significant corrections. Investors who'd bought in near the peak were facing massive losses. Pension funds had exposure to these investments, which meant everyday people's retirements were affected. The economic consequences spread further. When stock prices drop significantly, consumer confidence follows. People feel less wealthy, so they spend less. Spending drops, which affects business revenue. Businesses cut costs by laying off workers. Unemployment rises. The whole system starts to contract. We haven't seen the full extent of this yet, but the warning signs are everywhere. Credit markets also got tight. Banks that had made risky AI investments and faced regulatory fines had less capital to lend. They raised interest rates and tightened lending standards. Small businesses couldn't get loans for expansion. Entrepreneurs couldn't access capital. The financial system started to seize up in subtle ways. International markets got affected too. Other countries had also invested heavily in AI infrastructure, trying to keep up with the United States and China. When those investments soured, their economies felt the pain. Currency markets became volatile. International trade got disrupted. Global supply chains, already fragile from pandemic disruptions, faced new pressures. The cryptocurrency industry, which had been somewhat separate from the traditional financial system, also got hit because many crypto projects were built on AI hype. Companies claiming to use advanced AI for trading, portfolio management, or prediction got exposed as frauds or incompetent. Investors lost billions. The lack of trust spilled over into the entire crypto ecosystem. Real estate markets showed signs of stress too. Commercial real estate, especially office space, was already struggling with remote work trends. But the AI failures accelerated the problem. Companies that had overexpanded, built massive campuses, and signed long-term leases started downsizing. Office vacancy rates climbed. Property values dropped. REITs that held commercial real estate got hammered. Investors who'd been bullish on real estate found their portfolios underwater. Consumer spending started to show weakness. People were worried about their jobs, concerned about recession, and less willing to take on new debt. Retail sales slowed. Restaurant traffic declined. Travel bookings dropped. The whole consumer economy, which drives about 70% of American economic activity, started to feel the chill. Automakers, who'd invested heavily in AI for autonomous vehicles that aren't anywhere close to working reliably, faced their own reckoning. Billions had been spent on technology that's still years away from commercial viability at best. Shareholders were furious. Stock prices fell. The companies had to write down assets and admit they'd overpaid for acquisitions. Insurance companies discovered that their AI-powered underwriting systems had been systematically underpricing risk. They'd been too confident in their models. Claims started exceeding premiums. Margins compressed. Companies had to raise rates across the board, affecting everyone's insurance costs. People already struggling financially got hit even harder. Healthcare systems that invested in AI diagnostic tools discovered that many weren't as accurate as promised. Hospitals had sunk capital into systems that sometimes performed worse than experienced doctors. The malpractice liability was significant. The confidence in AI-driven medicine took a hit. Ironically, this meant healthcare costs went up because institutions had wasted money and had to be more conservative in their AI deployment. Pharmaceutical companies that used AI for drug discovery found that the process was still fundamentally difficult. AI could accelerate some parts, but the technology wasn't the magic bullet it had been marketed as. Development timelines didn't shrink as much as promised. Companies had overspent on AI infrastructure relative to actual productivity gains. The advertising industry, which had bet heavily on AI for targeting and personalization, faced pushback from consumers and regulators concerned about privacy and manipulation. Advertisers had spent billions on AI systems to micro-target users, often using the same invasive surveillance data that got banks in trouble. Regulations started restricting what they could do. The return on investment for many of these AI advertising systems didn't materialize. Governments themselves had made AI investments and faced consequences. Defense departments spent fortunes on AI weapons systems, AI intelligence analysis, and AI cybersecurity, much of which didn't work as expected. Public funds disappeared into black holes. Contractors made promises they couldn't keep. Taxpayers bore the cost of failed experiments. Educational technology companies that promised AI tutors would revolutionize learning discovered that students actually prefer human interaction, and that AI tutors were often frustrating and ineffective. Companies had gone public based on growth projections that assumed massive AI education adoption. When growth stalled, stock prices collapsed. Investors lost money. Employees got laid off. The energy sector felt the strain too. The massive computational requirements of running large language models meant enormous energy consumption. Data centers powered by fossil fuels were suddenly viewed as environmentally problematic, which brought activist pressure and regulatory scrutiny. Companies had to invest in renewable energy infrastructure, adding to already massive capital expenditures. Electricity costs for running AI systems became a major ongoing expense that made many projects economically unviable. Now, as all this money disappears and the consequences ripple through the global economy, we're seeing the beginning of what might be a significant financial market correction. Not everyone's talking about it yet. Some still cling to the idea that AI will save us. But the math doesn't work. The returns don't justify the investment. The promised productivity gains haven't materialized. The risk-to-reward equation has flipped dramatically. What happens next is critical. If the financial losses continue to mount, if companies keep writing down assets, if unemployment keeps ticking up, we could be looking at something more serious than just a correction. The artificial intelligence bubble was bigger than the dot-com bubble. The amount of capital misallocated is staggering. The damage to consumer confidence is real. The job displacement is accelerating. Some companies will survive and adapt. Some will fail completely. Some investors will lose everything. Others will find opportunities to buy assets at discounted prices. The market will eventually find a new equilibrium. But in the short term, there's going to be pain. There's going to be significant financial stress. There's going to be disruption in people's lives and careers. The lesson here is profound. Hype is not a substitute for reality. Speculation is not a substitute for fundamental value. Just because everyone's excited about something doesn't mean it's actually going to work. The $7 trillion that was invested in artificial intelligence was based on an assumption that growth would be exponential and inevitable. But growth doesn't work that way. Reality checks always come. And when they do, the consequences are severe for people who didn't think critically about what they were investing in. If you found this analysis valuable, please like this video. And if you haven't already, subscribe to the channel, because we break down economic and financial stories with real depth and nuance that you won't find in mainstream coverage.